Hello and welcome to the Portfolio Manager. On this show, we try and get in experts who are managing public money to try and understand how they are thinking about the portfolio construct under the current circumstances. Our guest today is Sanjay Parekh, founder and CIO of Sohum Asset Managers. It is a fund which aims to create a portfolio of sustainable and reasonably valued businesses following the GARP approach, which is growth at reasonable price, with an aim to provide superior risk-adjusted returns over the long term. Sanjay by himself has tremendous experience. From 2012 to 21, he was a senior fund manager at Nippon Life AMC. Prior to that, with ICICI Prudential AMC and Ask Investment Managers. Sanjay, great having you. Thanks for taking the time out. Hope all is well.
Thank you, Niraj. Thank you. My pleasure.
Tell us, Sanjay, how do you think about the market environment currently? Because and therefore, as a result of that, what is the kind of portfolio construct that you do? Is it more safe? Is it more biased towards large caps? And is it different from what you would otherwise do?
Yeah, Niraj. So, good afternoon. Essentially, ours is a large cap fund where we have said that at least 70% always would be large cap. Our average holding of large cap in the last 19 months has been 78%. Right now, we've moved up further, which is right around 82% in large cap. And then mid and small cap is another 16%. And the rest is, of course, cash. So our thesis has been that there is enough scope of alpha creation possibility even in large cap. And if you see the 1 year, 3 year, 5 year returns of Nifty, in fact, for 1 year, it's very starking where the Nifty returns on 1 year has been 17, 18%. But the average of the top 10, and I'm talking of average of the top 10, has done 65% plus. And the worst of the top 10, the average of the worst of the top 10 has just done 1 or 2%. So this is the divergence in return within Nifty. And our endeavor is to get the 18 or 20 stocks from the Nifty, and some of it which are not in Nifty but large cap is what we would seek to get. And in mid and small cap, our strategy is that the divergence has to be larger between price and value, which means our returns, ideally we would want to double them in 3 to 4 years, but not more beyond 4 years. So, for the risk that we take, we would want that sort of threshold of returns in mid and small cap. And by and large, it has worked, in this environment in 19 months, we would have done 16% over Nifty TRI. And on an annualized basis, also the alpha has been 11% over Nifty TRI. So for us, risk is very important. And hence, we don't add in one mid and small cap, we don't exceed 3%. So that's a risk measure we have at cost. As I said, we've got alpha in this environment, and mid and small cap has done exceptionally, almost twice of large cap. We've got alpha both from large cap and the mid and small cap as well. It's broadly equally spread. So we're happy with that. That's the strategy.
Why this bias towards, why this preference for large caps? Because almost everybody that I speak to, Sanjay, say that the real story is in mid caps and small caps. You see a tremendous number of sectors which have emerged off late, which largely have a mid cap and small cap presence and don't, by definition, strict definition, don't have a large cap presence. So how do you account for that?
Yeah, very valid point. So one is, you play your style. Over my career, the $4.5 billion that I've managed has been in a style wherein, you could have 70% in large cap and all the alpha you want to create, which you feel that it is more possible in mid and small cap, you could do that in the 30%. And then you position the product accordingly. So an investor across cycles, in the last 2 years, mid and small cap has done well. And exceptionally well. But if you take a 10-year view and if your product positioning is right, there's enough money waiting there for large cap funds, focus funds, who know the risk element, because that is also important. And we do emphasize that our fund has less risk, less volatility compared to mid and small cap. And yet, if we can deliver alpha, then I think we have done a reasonable job. So that's the positioning, and that's the way we think about it. But it's more, your main question is, yes, you play your style. I mean, right, if Sehwag plays like Dravid, he'll get out. If Dravid plays like Sehwag, he'll get out. So we said we understand this piece, and we're not staying away from mid and small cap. And we've got some great multi-baggers in mid and small cap, but we will want that threshold of returns. And if that fits in within compromise on quality, we'll love to add that.
Got it. Do you reckon the next 12 months could be months wherein alpha generation would be easy for anybody with a particular kind of strategy and you with your kind of strategy? Or do you believe markets might actually give sideways returns, considering that 2023 has been a decent year?
Yeah, Niraj, a very valid point. So one is, you just 2-3 years back, if we go, there were discussion around, and still it's on that, whether it makes sense in large cap funds to be in only passive, whether active fund management is relevant in the large cap space. But you can see it's not about us, where we've done 16% over Nifty TRI in 19 months. But a lot of funds have done well, even in the mutual fund space who have been into large cap, and the alpha is significantly larger. So we genuinely believe alpha in India, which is an emerging market, which is transiting and we are growing in size, the larger players also will become much, much larger, there was one news report of, which will be the next $1 trillion company in India in 2032. So this is the way we are thinking now. Okay. And that's where we believe that the larger companies also can have alpha, and that's showing up in 1, 3, 5 year return. And Niraj, I'll just emphasize, let's say Coal India 3 years back. And if you look hindsight, 5 years, very bad returns. Next 3 years, it's 3x. NTPC. You could take the largest bank, then SBI is up 3 times, but some of the other private names have not delivered. So you could have huge divergence within sectors and stocks in large cap as well. And if you can get those 18, 20 names and then add on with mid and small cap, you could have a blend. So coming to this year, I feel yes, alpha is possible, but this will be a year of mediocre returns because, the starting point of valuation is not cheap. And hence one will have to be navigating it very cautiously. One has to be having higher margin of safety when you're buying, particularly mid and small cap, and do understand that there is a froth in a lot of segments of mid and small cap. There are value there, but there is enough froth in certain segments that will be taking care of that.
So hey, just tongue in cheek, I must ask you. So what are those companies which will become $1 trillion out of India? I mean, just trying to understand what themes, because you said that you read that report and you're also thinking about that.
Yeah, I mean, it covered 3 companies and it's not the direction, but it did cover 3 companies. One was, and it said that if Reliance were to, and it's not about a stock recommendation, but it's about the big picture that we have started thinking that which could be the $1 trillion company. And as I said, next 6 months could be painful for those companies, but it had set 3 companies. One was Reliance. If it grows at 20% for till 32, and then, with the price burning and price to book, if it remains same, it was a math, it could be there, it could go there near $1 trillion. Second was what could be a cliche, but HDFC Bank. And of course, the implied growth there expected is 25%. We may say it may not grow 25%, but even if it doesn't happen in 32, but it happens 35, but the direction you can see that what could be the size of the market cap of a company which is today 15 lakh crores, around, less now because the market cap has gone down. So around 12 lakh crores. So this is the way. The third was, of course, Bajaj Finance, which has to grow significantly larger. So it may not happen in 32, but it could happen, might as well happen few years ahead. Yeah. But the main direction is that these growth large companies can really turn out to be winners in the next 10 years. That's the main point.
Got it. Viewers, just to re-emphasize, viewers, in case you misunderstood, this was more an abstract question about a particular note and how people think about things. Not that Sanjay Parekh is saying that any of these businesses or any of these stocks could actually hit that particular number in a particular year. They may not do it at all for that matter, but it's just about the thought process. And it's good to know that thought process, Sanjay, and therefore, which probably aligns with the thought process that you have a large cap bias, because the larger companies in India can certainly grow very high and become very large, and that might itself give you alpha as well. I'm inclined to, before we take that break, to ask you, if you look 3 years out, Sanjay, because I'm guessing you don't invest just for the next 6 months to 12 months. If you look 3 years out, where is it that you believe within the large cap universe, within banks, within IT, within whatever else, which theme has the highest probability of giving the best CAGR returns? Because while private banks may look reasonably valuable right now, there are concerns around their growth, not just for the largest bank, which has been badly beaten, but some of the others too, which are not quite reacting to the results in a positive way. And IT, everybody's talking about how the near term is fraught with discretionary spend coming off concerns as well.
Yeah, so, ideally our portfolio is reflecting that, but I'll tell you the themes. One, and your Niraj, I'll just tell you a caveat. We do look at last 12 months returns and underperformance, but we at times look at the forward looking, and at times you actually bought stocks which are underperformed when we think that it is overdone and the outlook is good. And very, very clearly, some of them give you great opportunities. That great franchisee in tough times, which are very short term in nature, gives you the best opportunity, particularly at times if there is a heavy selling due to some FIIs or whatever. Having said that, coming to the sectoral themes, we in the last 19 months, it was very simple: domestic overweight, global underweight. By and large, it has worked. In the last 6 months, IT has outperformed and our underweight has not helped us. But otherwise, and then pharma, we've already moved up. But the whole theme of auto ancillaries, cement, capital goods, telecom, real estate, each of them, financials, the whole gamut of financials, and luckily our entry price was right 18, 19 months back. So last 12 months has not hit us as much. And today we are equal weight on banks. Overall financials, we are overweight. So each of the themes we like. Within financials, the private banks, it could be select PSU, which we like the largest name. It could be an AMC company. It could be a wealth provider. It could be an insurance play. It could be a microfinance company. It could be a digital company. So you have a huge amount of gamut of plays. And some of these companies can really be meaningfully large in 27, So 27, 28. So we genuinely feel that rightly you ask the 3-year time horizon, and we think these themes will do well. Pharma also, we've gone overweight, mild overweight. There will be select opportunity. Oil and gas, we are underweight. Of course, O&M companies, we are overweight. But overall, oil and gas, we are underweight. And IT also, we feel that we will remain underweight because the growth clarity is less, and we're not comfortable with that in terms of growth uncertainty.
Okay. We'll probe some of these on the other side of this very quick break. Sanjay, stay tuned. So much more to glean from you. We'll take a quick break and come back with more on the Portfolio Manager. back with the portfolio manager in conversation with Sanjay Parekh, founder and CIO at Sohum Asset Managers. Sanjay's given us an idea of the portfolio that he has built right now for the next 12 months, wherein he believes that the returns would be a lot mediocre relative to 2023 or even in absolute terms, because we're coming at a very high base on the valuation front. Now, Sanjay, I was looking at financials, for example, the largest weight. You present in private and public banks, as I saw in your portfolio. You present in BFSI or lending financials. In the non-lending space, I saw an insurance name, but I didn't see AMCs, I didn't see capital market plays in a meaningful way, whether they are the utility players or wealth managers or brokers. Did I miss something, or are you not quite keen about them?
No. I think there's a great opportunity. I just disclosed, we used to own Angel Broking, and it was there for last 18 months, and it was a fabulous three-bagger for us. But we really felt that it is expensive, and we booked profits. On the AMC, and we clearly watching them closely. We like the space. But we genuinely feel the opportunities all over in financials. So it's just the relative game. So in NBFC space, also you could see Bajaj Finance. We added Paytm way down, and again it worked well for us. And we're looking at a 3-year horizon, where from our entry points, at least we think could double. And in the larger banks, as you said, we have the larger names. We like the space of broking, wealth, AMC, all of them. It's just that we want to enter at the right price.
Got it. So you're waiting. So you like the space per se, maybe waiting for the opportune time on the non-lending financials. Okay. Insurance for the longest time, Sanjay, hasn't given the kind of returns that one would expect. The PSU insurers have actually destroyed wealth. The private insurers too. I mean, you haven't seen the returns, so why stay constructive?
Yeah, so we don't own as of now.
Actually, you don't. Okay.
Yeah, we don't have insurance right now. We were worried about earlier the tax regime changes and some of the premium customers which were using that loophole, I would say, to get into those products which eventually would be tax-free. That loophole was plugged, and we could see some impact of that. Protection now is getting better, and then ULIP, of course, is getting better, but overall APE growth is still sanguine, broadly. And I think a little bit of it is because of the financial saving in terms of prioritization. We believe, start with most of them would always first have PPF, then small savings, then fixed deposits, and now mutual fund equity is doing well. So insurance takes a little bit of backseat, and the financial saving is limited. The overall pie is large, but if you see the portion, even RBI has highlighted that the financial saving piece still has to get larger. So within that, we believe insurance will take a little step down. And this is near term, not the long term. They're absolutely impeccable franchisee, and we like some of them. But it's just on a relative basis we would want to avoid for a while. And at the right entry point, we would certainly look at one of them.
Well, hopefully the right entry point comes soon, because some of these stocks haven't just quite given returns. What I saw was interesting in the portfolio was that there is an exposure to electric utilities by virtue of one company, and please correct me if I'm wrong here. But the power space, Sanjay, has been very, very active. So my question largely would be, how are you playing this? Why are you avoiding this? Because I don't see power financiers. I don't see too many power names. Is it because of the large cap bias that you're avoiding this pocket? Or how is it?
Absolutely. No, Niraj. So, yeah, you're right. We could have, in hindsight, added more of utility space. We, of course, have JSW Energy, and it's worked very well. It's almost 100% up for us in the last 1 year or so. And here is a company where it's transiting from a pure thermal play to a renewables play. Its thermal EBITDA contribution was 2,500 crores 2,000 to 2,500 crores. That will remain. But the new energy piece would move from, now 3,500 crores to 5 and then 7,000 crores. So total EBITDA itself this year should be 5,700 crores, which can move to 7.5 to 8 and then to 10 to 10,500 crores. So these are the transition without not a single dilution. There has been a debt increase, but it's within the debt EBITDA bandwidth. So these are the companies we like, we'll hold on. Then what we've done is on the whole theme of investment, we have logistics where we have Adani Port, which we like a lot. Then in cement, we have Ambuja and Grasim, which we participate in Ultratech through Grasim. And the whole piece and capital goods, we have Larsen as a overweight. So that's how the whole basket has a fair representation. But you're right, we could have still higher representation to utilities through Power Finance or REC or through any one more renewable name. So you're right. Or the equipment name. So there in hindsight, it is certainly we could have done better.
Sorry, I didn't mean to say that you could have done better otherwise, because I'm sure you've done very well. I was just wondering if you don't like that space. I mean, do you believe valuations are stretched there?
No, it's absolutely a great opportunity. And ultimately 10 or 20% is 20% is fine. When stocks moved up 100, 150%, there has to be a rationale. And rightly, some of them are moved. So we had looked at it, the whole new energy equipment space where we have two companies, Inox and Suzlon. Then the utility space, which could be NTPC or Tata Power or JSW Energy, and we got one of them. And then, of course, the power financiers like PFC, REC, you could participate in each of them because there we could really see that demand supply is moving in favor of generation. And at least the SEBs are now more disciplined. Will not say we're end of it. There's still pain there, but we got better. And the government support is also there to the sector. So, and the new energy piece clearly will do very well in the next 5, 7, 10 years. So that theme was absolutely bang on, and we could have represented it higher. So you're right in asking, that we should have had more weight on that.
No, not at all. But just that, Sanjay, we are completely out of time, but I have to ask this to you. Everybody's talking about premiumization. We have last 60 seconds. Are you playing premiumization at all? And if so, how? 60 seconds.
Yeah. So the theme, consumption, we could participate through auto ancillaries, through, as I said, financials. In fact, I genuinely believe cement is also consumption because it's housing. So we're looking at from that perspective, and there we are certainly participating. But overall, premiumization is a theme. That's not how we looked at it. So that's the summary of it.
Got it. Well, Sanjay, lovely talking to you. Thank you so much for giving us some insights. And we're talking in January. Look forward to talk to you soon enough. Much appreciate your time.
Thank you, Niraj. Thanks a lot, and best wishes to your whole team.
Thank you so much. Much appreciate, really appreciate your time as well. And viewers, thanks for tuning in to this episode of The Portfolio Manager.